Well, hello and welcome to all of you joining us today from across the world. Welcome to you from us in the UK, across Europe and in North America. What a great topic we have for today's webinar. Many of you have been with us on some previous episodes in this series, been really informative, and we've dug deep into various aspects of supplier finance. But what's the big question that everyone really wants to know? It's if we launch a supplier finance program, is it going to work? So today we have some great speakers who are going to share with us the best available data on what has worked in the past and drawing out some of the trends we can see that are going to help us to build better programs in the future. This session is sponsored by our friends at Orbian. We're very grateful to them, and I'll be introducing Tom Dunn of Orbian along with our other speakers in just a few minutes. Before we get there, for everyone here, a few housekeeping points so you can get the most out of this event. The first thing to bear in mind is that up on the right-hand side of your screen, that's up there, you'll see 4 tabs. If you can't see them, there's a little white arrow in a black box. Those tabs are a chat screen, questions, and that's really important. If you have a question for our speakers, type it in there, and if you see a question you like, simply upvote it, and I'll be asking those questions of our speakers towards the end of the webinar. There's a poll, and I'll come to that in a moment, and that allows you to get an idea of what other people in a similar position to you are experiencing at the moment. So a very, very simple platform. The last thing to say is you will be able to watch a recording of this event immediately after the live event finishes. So don't worry, if you miss something, you can watch it on the replay and send it to colleagues if you think they'd be interested. So I'm Mike Hewitt, as I mentioned, here at Adagio Media in London. This is our London office behind me. And our topic today is supplier finance. Does it work? And the first thing to note, and this is from Supply Chain Finance Community Research with PwC last year, is that it's certainly growing in terms of corporates adopting supplier finance. 53% in last year's survey said yes, they were running a supply chain finance program, many more considering running one. So certainly it's an idea that's now popularly adopted, but do all of those programs actually work? Before we get there, let's start with that poll. If you click on the poll tab, you can answer this question. If you're a supplier or a vendor, and I can see there are several of you with us today, just feel free to answer on behalf of the client if you like. Where are you on the journey to supplier finance? Not really considering it, in which case I might question why you're spending an hour with us. So I'm not looking for a huge response to that option. Maybe interested, perhaps you're evaluating programs, or maybe you already have a program in place. So feel free to vote as and when you wish, and we'll come back to the results of that poll later. But what we're going to do now is look at what makes the difference between success and failure. Some programs end up with a majority of suppliers, certainly the largest suppliers onboarded. They have longevity. Suppliers are using the program. They're benefiting from the financial support they receive. And of course, the big buyer at the top of the chain is benefiting from the advantage of a secure supply chain, often from working capital benefits. So it's a kind of win-win situation for everyone. That isn't true of every program. Some of them wither and die. Some of them start really well, fade away, and are forgotten in a couple of years. How do we make sure that is not going to happen to us? Well, 3 people who know all about this. Professor David Woodger is from the TUM School of Management in Munich. He's been running a research program using data from Orbian, and from Orbian we have Thomas Dunn to help us understand some of the data that's come out of that long-term research program. And we're also joined, I'm delighted to say, by Doug Scott from Siemens, one of the very first multinational companies to put in place a genuinely successful supplier finance program. So if you want to talk to someone that's been doing this for years and kind of knows how it works, talk to Doug, which is exactly what we'll be doing later on in this presentation. So that's enough from me. As I say, if you have any questions, use the tab. You shouldn't hear from me again until it's time to introduce our next speakers or to take some questions. For now, I'm relieved and delighted to hand over to Professor David Woodger. David, over to you.
Thank you very much, Mike, for this warm welcome, and good afternoon to everyone to this session here on supply chain finance. Now, what I want to talk about, as Mike mentioned, is a collaboration that started many years ago already together with Orbian. And I want to talk about data analysis. But I thought, since this is a short presentation, instead of doing it the formal way that we like to do in research, come up with hypotheses, test them, show the method behind it, I want to start directly by jumping into the top 3 lessons learned since we started this project. And if at the very end of this presentation, it's only this one slide, it's only these 3 messages that you remember, that's already good. And if you remember that these resulted from a solid work and rigorous analysis of real data, that would be even cooler. Okay, so what are the top lessons learned since our collaboration started in 2012? First of all, have programs ready for small suppliers, not only for the big ones, but it really is important. And we can show this in the data that you also need to accommodate for having small suppliers on the platform. Second, it's about sharing the benefits, not trying to get the maximum benefits for the buying firm, but it's really about sharing benefits, about harmonizing payment terms, something we can see in the data. And third, we observe that it's important to allow flexibility because some suppliers need this form of flexibility. And what I mean by flexibility is something I'm going to touch on later. So when we talk about supply chain finance, I hope we all have, in a certain sense, a common understanding. It is based on approved invoices. So supplier makes delivery to the buyer, sends an invoice, a buyer confirms this invoice, for instance, to Orbian or another third party, and that party then gives an immediate payment to the supplier, and the buyer settles the invoice payment later on, typically after some extended payment terms. Okay, this is supply chain finance, what we are talking about here in our study. Now let me come to the first point that I want to make, and now let me provide some technical and empirical argument why I say have programs ready for small suppliers. So what we did was we analyzed over 1,400 buyer-supplier diets. That is, we had data on the buyer, data on the supplier, and the program, which we put together. We wanted to understand how long does it take for suppliers to adopt. As I'm sure most of you who have run into and have been running programs, you already noticed that it's oftentimes the buyer who likes to run the program, who wants to get the suppliers on board, but some turn out to be hesitant. And that actually has been found to be one of the key challenges in industry. So we wanted to understand what makes some suppliers to adopt faster, whereas others might need a couple of months, maybe even years. Looking into theory, we found 2 sets of drivers. One is efficiency motive drivers. Suppliers adopt faster according to this theory if they can make more profit, if it's from a rational perspective better. But there are also legitimacy motive drivers, such as those related to, is it that I'm the only one who's doing it, or are my competitors doing it? Am I the first one with my buyer? Or is this a program which is already more experienced? Am I more dependent? So specifically, we came up with 5 hypotheses. And today I want to focus on one specific one, and that is related to efficiency motive drivers, namely access to finance, which in this case is specifically a supplier size in terms of its total annual revenues. So does it matter? Does size matter in adoption speed? In other words, would smaller suppliers adopt faster? Well, we argue in deriving this hypothesis that smaller suppliers typically are less transparent and therefore have more difficult access to finance. Actually, this is one finding that has been shown across many finance studies, that is often the smaller suppliers that struggle more with getting access. Accordingly, when we test this hypothesis, we find that it's true that indeed smaller suppliers adopt supply chain finance faster. Put differently, when offered to join a program, those suppliers are quite quickly in signing up and already transacting on the platform, while larger ones might be still bothering. Now, I'm sure the question would come up, what is a small supplier? Well, we don't say small versus large supplier. We rather see it as a continuous measure. So you could say the larger a supplier, the slower it adopts, or framed positively, the smaller a supplier, the faster it adopts and joins a program, without clearly saying when is it small, when is it large. It's just more or less of a continuum. So smaller are faster on board. Now, why is that important? Because we also find that when you're approaching as a buyer, you're approaching your suppliers and you want to get them on board. If you can tell them, well, you're the first one or the second one, it takes suppliers quite a long time to really get on board. If, in contrast, you can say there are already 40 suppliers or 50 suppliers, the more the better, the faster the next supplier is on board. Why? Because this is normative pressure that you build up. You can say, this is the standard approach that we are using. Everyone does it now. Look how many suppliers we already got on board. You should join too. Otherwise, it's kind of strange that you are not on board whereas everyone else is. So what you could do is get the small suppliers on board and then use this as a sales point and say, look how many we already got on board, and get the other suppliers as well. So in short, have programs ready for small suppliers, because if your program does not allow to include small suppliers, if you require at least a minimum annual spend of say 5 million or 1 million US dollars or euros, then it might be very difficult to build up success cases that you can then later on use in order to convince other suppliers. Second, share the benefits, harmonize payment terms. Now, this was a very interesting question for me when I looked into it. It's related to the question of how much can you or how much should you expand payment terms as a buyer? Well, we all know that there's this motivation of why do you introduce supply chain finance? Of course, to do something good for the suppliers, but we also know that very often buyers tend to combine it with an extension of payment terms to see and to benefit also from positive effects on their own working capital. Now, when we look into theory and then ask, what is it, how should you behave as a buyer, then it's very clear that you should try as a buyer. Of course, if this is your motive, if your motive is to expand payment terms, then expand them as much as you can. When can you expand them most? Well, if they are already long. Why? Well, think about a supplier with very short payment terms, say 5 or 10 days. Now, if a supplier is on 10 days, then the benefits of getting the money faster is marginal. It's only a couple of days faster. So why would a supplier be willing to expand payment terms? But if this supplier is already on 90 days, it should be, according to theory, be willing, 90 days, getting them down to a couple of days just for processing the invoice, that would be a huge impact. And therefore, they should be, in theory, be willing to expand payment terms more. So what we would expect is basically, we would expect to see a positive correlation between prior payment terms and the extension of payment terms. To analyze this, we used the data set that was kind of provided by Orbian, where again, we looked into over 1,400 diets with full data. And what we have as a measure is, one, we have the payment terms prior to adopting supply chain finance, so the initial payment terms. Then we get the supply chain finance adoption, and we get the payment terms after supply chain finance adoption. We can now take the difference out of those two, and we got the extension. And then we can test whether there's a positive correlation, if you will, between the extension and payment terms. Of course, looking from it from an econometric perspective, we do some more advanced models than simply looking into correlation, because there are many other things that are going on. So what I did was basically that I first estimated a structural model based on which I then ran a panel regression model. But I want to spare you the details now. I just want to look into the outcome. And the outcome is this, that managers do not follow the theory here. And if you look at this, I know it's a bit small print here, but what you can see is the dependent variable is here the payment terms extension. And the independent variable in this case that I highlighted is the initial payment terms, the payment terms prior to supply chain finance. And you see in the last column, that's an important one here, it's a full model. You see that there is a negative sign, which means the longer payment terms already are, the less they are expanded. And you can see a lot of stars or asterisks beyond this. That means it's highly significant. What does significance mean? And we can take a bit of a closer look here. What this really means is it's not random. It seems to be a systematic effect. And the probability that we just picked up an effect that does not exist but is shown in this sample, this probability is below 0.0001. That's very unlikely that it's purely random. So what does this coefficient of minus 0.86 tell us? Well, for 1 day more of initial payment terms, the extension is 0.86 days less. which means that there's almost a perfect harmonization going on, because for one day that you already have more, you extend it by almost 1 day less. That is, buying firms accordingly do not try to expand as much as they can, but really harmonization is going on. So what this is telling us is that buyers are not here about to push payment terms to the maximum limit of what is possible, but it seems to be relevant to harmonize payment terms, because this is what we see in the data, and there are strong and very efficient companies in there, and they must have good reasons for harmonization. For instance, for better comparing suppliers, making them more similar, and other reasons. And I'm sure that later on in this webinar, we will hear some more arguments. Coming now to the third point I want to make, that is allow flexibility some suppliers need it. What do I mean by flexibility? Well, there are different programs, as you might know, and they are all set up in a different way. This program, for instance, to which this data is pertaining to, has two options in which a supplier can use supply chain finance. One is automatically. That is, whenever an invoice is uploaded, it is automatically then related to a cash flow, and the supplier receives the money immediately. However, a supplier could also decide to go for a manual approach. In that case, a supplier sees and is informed that an invoice has been released, and from that moment on, the supplier is entitled to receive the money. However, the supplier might not need cash at that moment and could simply wait until the due date, and whenever the supplier needs money, it says on discount and gets the money. By waiting longer, the supplier pays a smaller interest charge, which is good, but then again, it gets the money later. Now, when we compare those two, automatic versus manual, then we see in automatic, you get the money immediately. It's a lean process. It's very efficient, right? You just get the money. You don't have to consult a website. On the other hand, the manual approach is more about whether and when to discount discount an invoice that's still open, and it somehow allows for more sophisticated cash management. Now, we thought initially that actually the biggest advantage of using supply chain finance would be for firms if suppliers have a poor credit rating, have high cost of debt, have difficult access to finance, and therefore we would expect all suppliers to be financed at rates that are worse than what you get in supply chain finance program, and therefore I would have expected all suppliers to be on an automatic mode, because why would they wait if they can save money? But it turns out that indeed there are suppliers which do wait, which use a manual approach here. Now, I was interested in looking more into the motives. Is it really important to allow a manual approach? Is it what could be a possible reason? And thinking about it, one possible reason could be that suppliers are interested, into delaying it until they really need the cash. Maybe they need it for an investment project, or because cash is something good to have that is more valuable to display on a balance sheet than, cash or money on your bank account is more valuable on a balance sheet than accounts receivables. So let's look into what happens, because if that conjecture would be true, we would be expecting more manual discounting transactions and more volume to see in the end of each quarter than at any other month. So let's look into the analysis of over 87,000 transactions of manual suppliers. And you can see here the volume that has been transacted. I think that the actual numbers are not so important, but just to compare it. On the horizontal axis, you can see the year and the month. So it starts in 2012 with January, 2012, February, and so on. So one thing we notice over the years, there's been more transaction going on, which is perfectly normal because the program was growing. And actually this goes until 2017. I think the data collection stopped in April, which is why there's not so much data there, but you can see a growing trend. What's more important to me though, is if we look at it, and now this is a bit messed up, but maybe you can see what I mean here and what I'm trying to highlight. There are certain months where we have peaks. This is 6, 9, 12, 3, 6, 9, 12, and this is repetitive. So it's whenever you are ending a quarter and you're looking into what is the financial state of a company, then you can see there is a somewhat steeper amount of transactions being handled by manual suppliers. Particularly when there's a 12, when it's December, it seems to be even more at the end of the year when suppliers really want to turn receivables into money on the bank account. So what this basically says is, if you want to have suppliers on board that have other motives, maybe they are not really interested so much into always getting paid because they do have cash, they still need supply chain finance because there seems to be a motive that end of a quarter, it's good rather to have the money on your bank account. So in summary, what is important? What are the 3 top messages to be learned? Have programs ready for small suppliers, share the benefits, harmonize payment terms, and allow for flexibility, because some suppliers obviously need and appreciate it. And with that, I would like to close my presentation and hand it back over to Mike.
Thanks very much, David. Really, really interesting. I think 3 superb points. If I can ask you just very quickly, I know we're doing questions at the end, but there are a couple that are just for you that pertain to this presentation. Alberto Martellini has asked about the sample size, roughly how many suppliers each buyer might have. But can you tell us anything about, how big was your sample for this, just roughly?
So what I can say is about the sample is 2 questions basically, or 2 answers. So one is the sample size is much larger than 1400 because we got all data from Orbian, and I'm sure Tom can say more about the scope of this program. However, there are some voluntary data that firms can enter. For instance, what is the revenue of a supplier? What have been payment terms prior to adopting? My analysis is really based on all complete data sets because we needed all data. And so we did list-wise deletion, which ended up with over 1400 diets. But the data set itself is much larger. And I have numbers from a couple of years ago. So I think it would be a good question for Tom to say how many suppliers and buyers there are at the moment in the program.
That makes absolute sense. And a second question, which a couple of people have asked, Chris Milner being one of them. When you're mentioning small suppliers, are you referring to the spend with a particular buyer or the size of the supplier itself? Because, of course, a very large company could be a relatively small supplier to a particular customer.
That's a very good point. So actually, we are talking here about revenue of the supplier, not annual spend. And we do so for the reason why, because exactly as you point out, it could be, if we just look for the revenue, that a large firm has small revenue and this large firm would still have good access to finance. But our hypothesis is really based here not on whether they have small annual spend, but whether they are able to finance themselves on the open market. And we believe that this is really dependent on their size in terms of revenue.
Tremendous, David. Thank you for that. There are more questions coming in. I can see several, Jan, Tapan, Kirill. I can see all of you asking questions. We will get to those later on, I promise you. For now, David, thank you very much. Tremendous presentation. Some really interesting thoughts for all of us. I mentioned earlier, of course, that what we really want to hear from is someone who's been running programs like this at the sharp end for years. Siemens, one of the first companies to really put supplier finance on the map on a global scale, and closely involved in that right now is Doug Stock. So Doug, can I hand over to you and just ask you to tell us a little bit about your experience, the Siemens experience, and what you've learned that might help our viewers to succeed in their own programs?
Yes, I'll do my very best. Thank you, Mike. And thank you, David, for that presentation. I appreciate the offer to come and speak today. And hello, SEF community. I hope everyone is doing very well. So I will do my best to share some of the experiences that I've had and Siemens has had over these past now 12 years since we've introduced the supply chain finance program at Siemens in the United States. It has since grown and is now a global program. One of the things that I will say right up front is that our experience is that good communication, both internal and external, along with continuing education of the supply base, the suppliers to the Siemens companies, is the absolute key, in my opinion. And one of the things that we try to do is to put forth a very straightforward, and I would say almost simple, message to communicate to suppliers and also through the supply chain community within Siemens, and that the benefits of the program are not only cash flow and working capital improvement, but one of the things that we've learned over the years is that suppliers often are frustrated with their customers, with their buyers, in that they don't understand exactly what the status of their invoices are. They cannot see how things are flowing very well. And one of the things that we've been happy with in working with Orbian over the years is that suppliers that are active in the program do know. Once an invoice is submitted, they understand that if it's approved, it's there and it's available immediately for discounting. And therefore, that's going to hopefully translate into a cost reduction. That means, as I like to say, the amount of time and effort chasing money is vastly reduced or gone to zero for those suppliers that are active in the program. And that's been a real message that's resonated with many suppliers over the years. So there's a very simple, straightforward message of the benefits that the supplier shall receive, from being active in the program. One of the things we've done within the Siemens program very early on was to say, look, there are no fees to join. We have a very, very low bar here for entry into this program and also exit if the program no longer makes sense. I will say that in the very early days of the program, as David was saying before, we had a larger, let's say, minimum for entry into the program. We had started at about $500,000 US equivalent volume. And that quickly turned into, why are we doing this? We lobbied for a reduction to $100,000 US equivalent minimum volume for eligibility into the program. And that has since reduced even to a minimum of $50,000 now. So you can see that the expansion has happened. We've really made the program available to a very wide variety of suppliers. And as David was saying earlier, some of the smaller suppliers are those that are most interested and are very active in coming into the program. But we have, for the full 12 years that we've been active in North America, kept this very straightforward, simple 3-tiering for discount rates. And you can see the annual sales level is the volume of invoices that any supplier is doing with Siemens over a 12-month period. And that does not mean by Siemens company, that means in total. So if a supplier is supplying to a healthcare company and an energy company and an industrial company, it's the combined annual volume of invoices here. So again, staying with the concept of a simple message, this is the way in which we've gone to market across the Siemens companies and outreach to the supplier. We also, I will tell you that even today, this week, we are going to have an education session on a Tuesday, and we're going to have an education session on a Thursday. Early on, we decided that we would have, very similar to a COVID situation where we're able to reach out virtually. We have had usually 35 to 40-minute sessions running twice a week where we go over this information. And this is a very smart, quick way for us to communicate to suppliers directly or to supply chain management personnel throughout the Siemens companies. I think that's important, right? Because often there's turnover, and certainly there are new employees coming into the company at all times. And so it's a good way for internal education to happen, as well as good education out to the suppliers that the supply chain managers would like to join the program. And so we quickly run through a typical scenario. If a supplier were to come into the program, we just run through an example of a $10,000 invoice, how the rate would be applied, and the expectation that the supplier would have for a quick payment, in this case within 10 days, and the actual discount calculation so that they see exactly what the cost of the program is, and that's simply the discount. There is no other cost associated. Now, speaking to David's point earlier about small suppliers, large suppliers, it's nice to have one example, but it is, I think, also powerful to have an example that's germane or specific to any supplier that we're speaking with. So in our presentation, we have placed an interactive calculator so that the payment term can be changed, so that the amount of the invoice under consideration can be changed, depending on the tier in which the supplier resides. We can change the actual annualized discount rate and run a scenario. So if we're speaking to an owner of a smaller company, you can see exactly what a particular invoice, say a $5,000 invoice or a $50,000 invoice, what would be the actual discount taken? This is also proven to be very valuable and I think effective. Therefore, it's not fully generic. It's also specific when we're speaking to a particular company. And we found this to be quite helpful. And we wrap up this information session with explaining that here are the steps to enroll. Orbian has been quite kind in setting up what they term as enrollment rooms. So therefore, on their site, when a supplier clicks on this active link, they can take a specific enrollment code and simply enroll into the program. When I say in specific enrollment code, I'm talking about by country, right? As we have suppliers in many different countries, we want to make sure that the agreements that they enter into are based on the country law. And this is the way in which you do it. Again, very efficient. It's simply a one-click to the enrollment rooms, put in your code, and you're off and running. So that's it. I'm going to say that, again, I'll reiterate that internal and external communication on an ongoing basis and ongoing education are keys to the success of the program. And I would say that, following on that, as we wrap up this little look at what we do as far as reaching out to suppliers and educating them, we make sure that additional resources are there so they can simply click to our intranet and internet sites and also take a look at LIBOR rates themselves, right? Because as much as you want to hear from your buyer, there's also self-education, and we encourage each of our suppliers that are interested in the program to do some self-education as well. So, Mike, are you able then to run this?
I believe we can. It's the first time for everything, but let's see if right now we can get the Siemens video to go. So sit back and pick up your.
So we also have, just to say that this is also a YouTube site to educate about the program. Go ahead, Mike.
Okay.
You are part of a strong Siemens value chain with your products and services. In the age of a globally connected exchange of goods, long payment terms dominate, and this reduces your optimal cash flow as a supplier. Therefore, Siemens Financial Services has created a program that supports you exclusively as a Siemens supplier, Supply Chain Finance at Siemens. This allows you to sell your Siemens receivables at a 100% advance. As soon as Siemens has confirmed your invoice, you will receive your money quickly and reliably after an average of only 10 days, regardless of the agreed-upon payment date. Contrary to the conditions at your bank, the Supply Chain Finance Program interest rates take the strong credit rating of Siemens into account. This improves your financing costs, your cash flow, and your working capital. Comprehensive proof of liquidity, as required with other financing, is not necessary. You receive your money automatically. With Supply Chain Finance at Siemens, you can reduce costs and effort. How can you benefit from the Supply Chain Finance program at Siemens? Our Siemens Financial Services consultant will be delighted to tell you.
Yes, David, thank you very much for running that. I appreciate it. Sure. So again, I'm coming back to communication and ongoing education. And again, those are keys. I'll just end with this, that over the, you've got some data here in front of you to see the growth of the program throughout this past decade. Whereas we started in 2008, single entity in the US as a pilot, you can see how the program has grown, right? So we have many suppliers and in many countries and with many currencies. We continue to have lots of interest from domestic and international banks to continue to support the program. So we're very happy to share this with you today and let you know that the program continues to grow and is quite strong. Thank you, Mike.
Excellent. Thanks very much, Doug. We've got just one or two questions that have come in that are directly relevant to your presentation. And I think you've covered one of these, but Tapan Argabal says, was it a huge effort to train and educate your suppliers? And we saw in the latter part of your presentation, you spoke about the amount of education you had to do. But Tapan asks whether you sort of brought in an external agency for that. Was that all down to your own procurement teams? How do you handle the whole education and training bit for your suppliers?
So far, we've done this in-house. We have not brought in external firms to create either the messaging. I would say that there's been some trial and error. Certainly in the first 2 years, there was a lot of editing of material to I would say, simplify. To go from large, long presentations and lots of explanation to something that's cleaner and easier to understand. And that was from internal feedback, both from the supply chain community within Siemens, the financial community within Siemens, as well as input from suppliers over those first couple of years.
Tremendous. Thank you very much, Doug. And I can already see in chat you're getting some plaudits from our audience already. So do feel free to drop in there yourself and take the praise. Always good to have. Okay, thank you very much, Doug. Cheers.
Thank you very much, everyone, for your time.
Thank you. Thank you. I hope you'll stay around till a little bit later on when we'll bring Doug and Dave back for any remaining audience questions at the end. But for now, we've heard, of course, from the research side of things, from an academic study. We've looked at how a large corporate runs its supply chain finance program. But what about the people that make it happen? And now I'm going to turn to Orbian and ask Thomas Don to come onto the stage. Thomas, over to you. Tell us how you do it.
Thanks very much. Thank you, Mike. So it is now it's just a little over 8 years since we began our collaboration with Professor Woodger. We'd received many requests from industry-affiliated analysts and other sort of related parties to share data that Orbian was already even 8 or 9 years ago was really starting to accumulate large amounts of data on supply chain finance behavior and patterns of activity. We had a lot of inquiry to share this data with people that wanted to parse it and to start to draw it into some industry conclusions. But we decided that we wanted to really focus on supporting an initiative that was going to be based on the very highest standards of peer-reviewed international academia. And we did this really in order to ensure that supply chain finance would take its proper place as a long-term tool of collaboration between buyer organizations and their supplier networks. We wanted to move away from some of the simplicities, some of the caricatures that were being created, sometimes within the banking community, sometimes outside, and we wanted to really focus deeply on the behavioral aspects of supply chain finance and how it was going to operate. We've been delighted with the collaboration with Professor Woodger and his team, first of all at the European Business School and now at TUM. It's driving continuous improvement in our own SCF services, but also, and very importantly, I think that it has been hugely beneficial in building the credibility and position of supply chain finance overall as an industry and as a tool of global finance. So I just want to spend a few minutes or a couple of minutes on kind of each of the Professor Woodger's 3 key observations and seek to really illustrate how they've driven activities at Orbian. So first of all, have programs ready for small suppliers. Today, most large global corporations already have some form of SCF. But frankly, far too much attention has been paid on granting access only to the largest suppliers. Small suppliers, those that need it most, have too often been excluded. Orbian strongly recommends to all buyers that all suppliers, regardless of procurement spend, be given access to their supply chain finance program. Successful SCF is not about tweaking the dial on DPO with some very large suppliers. Rather, it should be about offering across the board collaborative tools to the broadest swathes of suppliers. Now, these are sort of easy words to say. What do we do to actually support it, and how does it come about? Well, Doug actually in his presentation referred to a couple of the things. We have very good, intuitive, and complete tools of supplier education. We have a fully digitized enrollment process. We have local language, documentation, education tools. We provide suppliers, if they wish to avail of a fixed rate alternative that eliminates the concern that they might have that LIBOR swings around. So we do these things, and then we genuinely encourage suppliers of all shapes and sizes to participate. Over 13% of the suppliers enrolled on Orbian's programs have less than $50,000 a year in annual sales. The largest single supplier procurement volume that we have, sort of as a single relationship, buyer-supplier relationship, is almost $1 billion per annum. The smallest last year was $9. We really do mean it when we say encourage all suppliers to join, because that is the way that the benefits are built out. Turning to the second one. This one was a somewhat counterintuitive result from Professor Woodger, but one that has really played out. Harmonizing payment terms rather than simply seeking DPO maximization is the key to long-term SCF and working capital success. And what are the factors that underpin this? I think the first is that the buyer is able to maximize the efficiencies of supplier payment logistics. It becomes a very more streamlined process within the payables function if there are simple payment runs that allow payments to be processed. It also allows, as Professor Woodger remarked, it allows suppliers to be compared equally across their relative merits of price, consistency of product, and delivery and logistical considerations without regard to the advantages, sometimes unfair, that might accrue to some or others by having longer or shorter payment terms. And it also then allows the buyer, by having harmonized terms, then to start to think about how to move DPO terms, having established what has now become a standardized protocol for their DPO terms, rather than simply seeking to push out individual suppliers, which can raise eyebrows amongst compliance officers, regulators, and the audit profession. So over our programs, we strongly encourage harmonization amongst buyers. We see it as being a huge source of value for buyers to bring to their program. And indeed, we see that over the first 3 years of any Orbian program, there will be a significant reduction in the variation of DPO terms that are offered to suppliers to that buyer. Turning to the third of Professor Woodger's observations, allow suppliers the flexibility to choose when they want liquidity. But this is rather different from some of the choice offerings that are provided under the guise of dynamic discount arrangements, which certainly have their role, certainly have their place, and Orbian provides dynamic discount arrangements for those buyers and suppliers that wish to have that type of facility. But more importantly, we feel that providing suppliers with genuine optionality where they know that there is liquidity, and they know that there is a price attributed to such liquidity that is available to them if they wish to take it, is a very much more powerful tool of liquidity optionality, and is a very important driver of, quite frankly, reducing the reasons why a supplier would not participate in an SCF program. At Orbian, we allow all suppliers to select manual discount alternatives. Approximately 15% of suppliers take such an option. Most prefer, 85% prefer the streamlined auto discount, but they value the offer. Even those 85% that on auto value the opportunity that they have at any point to switch to a manual alternative if they so wish. That's kind of sort of concludes my comments on Professor Woodger's three observations, but just kind of before I go, we're turning attention now with Professor Woodger and his team to the role that SCF can play in sustainability. And by sustainability, I don't just mean kind of environmental considerations, but far broader topics of collaborative benefits across all aspects of environmental, social, and governance goals that a buyer might have. We have been working on these over the last 12 months or so. We presented some preliminary findings at the Future Planet Impact 10X conference last year. These results are extremely exciting and already starting to show that there are very tangible benefits and relationships between well-structured SCF programs and the ability to support sustainability initiatives across both buyer and supplier organizations. And we very much look forward to presenting these results to all of you in the SCF community at a very early future date. Thank you.
Well, thank you very much, Tom. Tremendous presentation, and we'd love to have you. Sustainability is a really hot topic for us at the moment, and we'll certainly try to get you on the agenda for the SCF Forum in November, if not then from one of our events next year. As you might expect, we have a great many questions coming in, and I'm really sorry to all the banks and fintechs who have found their way into this webinar. We're very happy to have you, but we're going to prioritize corporates for obvious reasons, the people that are actually implementing supply chain finance programs. Douglas and David, I'm going to ask you back in to form a little panel, so feel free to rejoin us whenever you're ready. And we'll start with Frank Vafter of Puma, who is asking, and I think this one is for you, Doug, who says, can you see any patterns of suppliers from different countries whose adoption is much higher than other countries? So is adoption much higher, for example, in emerging markets? Are there any of those patterns? And maybe, Doug, you could have a go at this, and perhaps you might look at it also, David and Tom. So is there a geographical difference or any patterns in terms of markets? Doug, do you want to go for that first?
Sure, yes. Thank you very much for the question. I will say, since my influence is in the Americas, I can't speak really for the global, but I can say, in the Americas, where we have some difficulties is more along the lines of where currencies, in other words, the volume of supplier invoices in certain currencies will not allow for volumes to cover administrative costs. That's somewhat of a barrier. So where we do have suppliers, say in Mexico and other South American countries, where there's enough volume and the currency is attractive for banks, I would say that then it comes down to our supply chain management community looking at where there can be benefit for both parties. And I will say one thing from my experience, and I think I would speak for most of our supply chain managers, is that the size of supplier does not equal and does not have in Professor Woodger's vernacular, a high correlation to risk. Right. So the supply chain managers now are looking at where can we find where can we see potential operational risk with the supply community, and ask very kindly for the suppliers to come into the program. Why? Because we would like to reduce our operational risk through any risk that supplier would represent to us. So I would say we're more focused now on trying to manage that risk. And so, yeah, I may not be getting a full answer for you, but we would like to see, and we push now for suppliers to come in where we believe there could be the potential of us not meeting our customers' requirements due to, say, lack of cash flow on that supplier's part. So that's where we focus, right?
That makes absolute sense. So I'm going to put Frank's question first to David, to Professor Woodger, and then to you, Tom. So David, Frank asked, of course, whether there are any patterns in terms of adoption in certain markets, like emerging markets, for example. Was that something you looked at, or did that not form part of this current project?
Thank you very much. This is actually an excellent point, and we spent a lot of time investigating this one because we were also curious whether there's difference also between the US and Europe and different regions. Now, what I did in the meantime, I opened up the data set because we didn't put all the details about countries in the final paper. We controlled for it though, and I opened up now a version with the country controls, and what it kind of indicates is that compared to the US, adoption in Germany, for instance, or Denmark seems to be a bit significant. It seems to be significant faster. It is significant. It's not substantial. It's not like you would say, oh, this is so much faster, but it is a bit faster. Or in the UK, for instance. But compared to other countries, like let's say less developed countries, where there are fewer suppliers in the sample, there's no significant difference. Interestingly, though, I think that's one of the important things. The speed is often driven by elements such as the expected benefits and the initial payment terms and variables like this. Those variables differ across countries. And now, if you say in a let's say developing country, there we would have rather smaller suppliers, then yes, this goes along with those are faster to adopt. But then again, it's not just because it's developing, it's because they are smaller. And so I would say many of the effects are really already taken into consideration and accounted for through the other variables.
Okay, so that makes perfect sense. And Tom, are you seeing at an Orbian level, is there any variance? Are you seeing any particular markets that are growing faster than others? You mentioned the demand for the use of supplier finance for sustainability, for reasons other than just extending payment terms. Are you seeing any particular geographical changes in the way SCF is being used?
To be honest, the answer is no, not really. We tend to find, as David alluded to and Doug as well, the most important consideration is kind of getting a program out there. That overwhelms any country-specific considerations. The idea of delivering the program. I think that one thing I just add very briefly, so we can move on to some more questions, is with regard to emerging market countries. It is sometimes relatively harder to execute supply chain finance programs in those countries because of local regulations, because of local currency controls, local currency restrictions. So sometimes if the suppliers are dealing in US dollars, that can be fine. If they're dealing in Vietnamese dong, it can just be a harder path to go down. So I think we have to keep that in mind as well.
Okay, that's perfect answer. And Joel Curry, hello Joel, from Nippon Steel and Glass is asking, Joel is working capital manager there, asking particularly about the Siemens model, whether payment terms are standardized and is supply chain finance available to all suppliers. And I can see that Doug has actually answered that in the text, pointing out that a majority of operating companies have harmonized payment terms. But can I put that one to you, please, Tom? Generally speaking, in your programs, is supplier finance available to everyone, or is it more usual to say, well, actually, it's only available to those who are on 60 days or 90 days or 120 days or whatever?
That's generally speaking in our programs, it's available to everybody. It may be used as a soft nudge by the procurement folks, but that's up to the procurement folks. I mean, everyone's got a job to do, and if supply chain finance is designed to be a tool of collaboration between, if you like, the VP of procurement at the buyer and the VP of sales at the supplier. But as far as we are concerned, we make it available to everybody.
Okay, thank you for that. Now, in a moment, and I'll give you a little bit of warning, everyone. I always end these things by saying, look, if you could just give one piece of advice to everybody, there's one thing you should do. And it's unfair, David, because I know you gave us 3, and I'm going to be really harsh and say, if you could just say, just do one of these things, get that right, and that'll put you in the right direction. I'll ask you that in just a moment. Before we get there, multiple people have asked similar questions, and it's around due diligence and KYC, particularly with those smaller vendors. And Tom, I'm going to come to you on this one first, and then perhaps to you, Doug, for some particular backup from the Siemens perspective. But from the Orbian perspective, how difficult, and do you need to do it at all? Is there a KYC step, a credit risk management step for those small suppliers, or is that not necessary?
Great question, and you alluded to exactly the right issues there. We have to do KYC, we have to do AML, we have to do all of those checks that are required. We have very streamlined processes for those. Very importantly, though, we do not need to do any credit checks, because in every single transaction that we do, and to delve into technicalities for a minute, we do a true sale transaction of the receivable from the supplier, and that eliminates performance risk on the part of the supplier. This allows us to obviate the need for credit work on the part of the supplier. That having been said, in the US and in Canada, in Australia, we are required to file a UCC1, and we obtain a lien consent from any prior lien holder. Anybody that's already got a claim over the receivable that we're buying, we obtain their consent to acquire that receivable from them. But that is it. It's a very streamlined process that we have across the board in order to bring suppliers on across the board.
Okay. And just briefly, Doug, I mean, it'll be this, I'm guessing that's pretty much that answer covers Siemens too. Is it the same experience for you? You're not seeing suppliers seeing this as a barrier, the whole KYC compliance thing?
I would say that we have experienced with a small minority of suppliers a barrier with that particular item, right? Where a bank is not willing to then recognize the UCC1 filing. But it's a very small minority, and I would absolutely say that it has not been a barrier to the growth of the program. I still, after all these years, find it, I really don't understand why that would happen when it's in good business sense for the supplier to join such a program, and it's good business sense for the buyer supplier relationship. We're all in a service business. I don't care where you sit on the spectrum, banks included, fintechs included, buyers and suppliers included. We're all in a service business. What we should be doing is working towards a better end for all. And in fact, that's what this program does, and like programs. Absolutely.
So there's your answer. I know several of you asked similar questions. Credit, no. KYC and onboard, yes, of course, if regional and in-country regulations required, but it shouldn't be too much of a barrier. And apologies now to all of those of you that have asked more questions, too many for us to ask. So Arpan, sorry, Jan, apologies, we will get to you. Kirill, another question, and I'm sorry we didn't get to that one either. But it is time now to begin to wrap things up. I threatened you, presenters, with that dreadful last question. What's the one lesson you'd leave us with? David, you gave us 3. If we really came to you and said, no, come on, we can't do 3. What's the one piece of advice you'd give anyone embarking on a program now?
Think broad. Don't just think about payment terms. Think about all the dimensions that are involved to it, about timing, getting the incentives straight, and doing things right. And that's much more than just looking at DPO.
Brilliant. Doug, you gave us some great advice. If someone said, I've got 5 seconds, give me the one piece of advice I should take, what would it be?
Simplify the communication and then keep it up and keep it up and keep it up.
Brilliant. Tommy, you have the unenviable task of being the last when 2 people have already given great bits of advice. What's the one bit of advice you'd give to someone coming to you and saying, help, we want to do a great SCF program?
I really would say emphasize the availability of the program to all your suppliers. Build a program that you're going to endeavor to offer to everyone.
Excellent. Thank you very much for that. Okay, we've reached the end of our allotted time. That's the hour. Thank you very much to everyone that's been with us, wherever you are in the world. Almost as soon as I end this webinar, within about a minute and a half, the recording will be available. If you had any issues watching Doug's video, there is now a link in the comments and the chat section, so feel free to have a look at that, and do share the webinar with anyone else in your organization that would like to see it. For now, thank you so much to our panelists, to all of you, to Doug, to David, to Tom. Thank you, tremendous. And thank you, of course, to all of you for being with us, for your great questions. And we look forward to seeing you very soon. 19th of November, if you haven't had an annoying email from us yet, you will have very soon. The SCF Forum and Awards is online this year. So a little bit like this, but bigger. And if that's possible, even better. Until then, I'll see you on that date. But thank you again to everyone, and goodbye. Goodbye.
Cheers.
Thank you very much, everyone. Bye-bye.
Bye.